Welcome back. This week we're going to cover Chapter 3, and what we want to accomplish in Chapter 3 is to describe the nature of the adjusting process, journalize the entries for accounts requiring adjustment, summarize the adjustment process, and then prepare our adjusted trial balance. When financial statements are prepared, the economic life of the business is divided into time periods. The accounting period concept requires that revenues and expenses be reported in the proper period. And to determine the proper period, accountants use generally accepted accounting principles, or GAAP. The use of the accrual basis of accounting is required by GAAP. Under the accrual basis of accounting, revenues are reported in the income statement in the period in which they are earned. For example, revenue is reported when the services are provided to customers. Cash may or may not be received from the customers during this period. And this is called the revenue recognition concept. This concept supports the reporting of revenues when they're earned, regardless of when the cash is received. The matching principle, or matching concept, supports reporting revenues and related expenses in the same period, in the same time period. For example, utilities expense incurred during December are reported as an expense and matched against December's revenues, even though the utility bill may not be paid until January. And although GAAP requires the accrual basis of accounting, there are some businesses that use the cash basis of accounting. And under the cash basis of accounting, revenues and expenses are reported in the income statement in the period in which the cash is received or paid. A lot of small businesses use the cash basis because they have few receivables and payables. And these statements provide, or the cash basis provides, accurate financial statements for these users' needs. Some example of people that use cash basis of accounting is attorneys, physicians, real estate agents, accountants. All of these use the cash basis of accounting. However, for larger businesses, the accrual basis better represents the income of these businesses. And for that reason, we use the accrual basis in this text. Okay, now we're going to talk about the adjusting process. At the end of an accounting period, many of the account balances in the ledger can be reported directly on the financial statements without any change. Examples would be cash, land accounts, machinery and equipment accounts. All of those normally just flow right over to your balance sheet. But under the accrual basis of accounting, some accounts in the ledger require updating, and that's necessary for three main reasons. Some expenses are not recorded daily. An example of that is supplies. The amount of supplies used on a daily basis is usually very small, and so we just don't make an entry each day of the period. We just wait till the end of the period, we inventory our supplies, and then adjust them appropriately to supplies expense. Some revenues and expenses are incurred as time passes rather than as separate transactions. An example of that would be rent received in advance, or unearned rent. It expires and becomes revenue with the passage of time. And another example is prepaid insurance. You know, I've already told you all insurance is prepaid. And normally we prepay our insurance for at least 6 months or maybe a year in advance. So at the end of the month, if we're doing our financial statements, we would want to move that portion of that insurance that has been used as an expense into the insurance expense account for the period. And then we have some revenue and expenses that are just unrecorded at the end of the period. A company may have provided services to its customers that is not billed or recorded at the end of the accounting period, and so we would need to make an adjustment. Likewise, a company may not pay its employees until the next accounting period, even though the employees have already earned their wages in the current period, and so we would have to make an adjustment for that. The adjusting process is the analysis and updating accounts at the end of the period before the financial statements are prepared, and that's called the adjusting process. The entries, the journal entries that bring the accounts up to date at the end of the accounting period are called adjusting entries. All adjusting entries always affect at least one income statement account and at least one balance sheet account. Thus, an adjusting entry will always involve either a revenue or an expense account and an asset or liability account. And we're going to take a look at example exercise 3-1. On this exercise, they give us 6 accounts and want to know if adjusting entries are required. Of course, it tells you on cash that there's no adjusting entry, and that's because we adjust our cash every time we write a check, we record the check, and adjust the cash balance. Anytime we make a deposit, we make sure we enter that into our cash account. So cash is adjusted on a daily basis. Prepaid rent, however, is not adjusted on a daily basis. Prepaid rent, we may pay our rent in advance for 6 months. If we do at the end of each month, we would need to take out that portion of the rent that's been expensed for that month and record it as rent expense. Wages expense, like I said, almost always have to make an adjusting entry for that because we don't pay our employees until after the services are performed, and so at the end of a period we normally have some amount of wage expense that we need to recognize in our current period. Office expense is another balance sheet account that is not adjusted on through the adjusting process. Accounts receivable would be adjusted at the end of the period if we have performed services for our clients and have just not billed them out yet. We would want to bill out those services or make an adjusting entry to bill out for those services, debiting accounts receivable and crediting fees earned. Unearned rent is another example that we would have to make an adjustment. Like I said, all rent is paid in advance, and if we received 3 months rent in advance from somebody that we're renting to, at the end of each month we want to take 1/3 of that amount and recognize it as rent revenue. And so we're going to stop at this point, and then we'll pick back up on page 102 and talk about the types of accounts that require adjustment.